Good afternoon, everyone. With rising interest rates, a flattening yield curve, and a weakening dollar, and increasing inflation expectations, there are no shortage of interesting topics to discuss in the fixed income markets today. I would like to first thank our panelists who are making their way to the stage now, and I'd like to quickly introduce them. We have Arthur Hovsepian, Portfolio Manager in Payden and Rygel, Luz Padilla, Director of EM Debt at DoubleLine Capital, and Keith Luna, Portfolio Manager at Western Asset Management. The panel will be moderated by Eric Sussman, Adjunct Professor here at UCLA Anderson. And with that, I'll turn it over to Professor Sussman.
This is way more comfortable a chair than when I get in the classroom. Nice. All right, well, good afternoon, everyone. We already did a sort of brief introduction of our panelists, so I'm going to let them talk a little more detail about themselves, their backgrounds, and whatnot. So why don't you guys do that? Let's just start, just say a little more about your backgrounds, your position, your firms, where you guys play in the debt markets, and that sort of thing. We'll go from there.
Sure, I'll kick it off. My name is Arthur Hovsepian. I'm a portfolio manager at Payden Rygel within the emerging market debt team. I grew up in England, went to University College London for undergrad, started my career in London, moved to New York, then to the West Coast with PIMCO, and I've been at Payden for 14 years. Focusing on local markets for the majority of the time, but have been doing a lot more of general portfolio management in recent years.
Okay,
Luz,
great. My name is Luz Padilla. I run the international fixed income team at DoubleLine. We have about $9 billion of assets under management, mostly in emerging market debt. And that's because that's my background. I started working in emerging market debt after business school in '94 and moved from TCW to DoubleLine in '09.
My name is Keith Luna, and I'm a portfolio manager at Western Asset. I cover long duration LDI and insurance strategies along with the rest of our broad market team. I've been at Western for almost 15 years now, coming out of undergrad. In the middle of that, I'm proud to say I also did the FEMBA program here at UCLA, class of 11. So,
Right, they left out two important details. Keith and Arthur are both former students of mine, so if you guys don't know what you're talking about up here, I'm in big trouble. Luz went to Berkeley, but we'll forgive her.
Thank you.
Why don't we just start? We'll start, with you. Just, general question, outlook on your specific sector, and what you're seeing out there, what you guys see for the rest of 18 and 19, I suppose. I know predictions are tricky, but give us your best shot.
No, happy to start out. As Jay said, we also do not tend to like to make a lot of forecasts. I have clients that ask me for forecasts all the time, and I usually just tell them, well, I'm putting my finger up in the air to see, every forecast is guaranteed to be wrong by some large magnitude to the upside or the downside. But in terms of what we're seeing out there, in general, we tend to think that global growth is picking up from very subdued levels. Along with inflation, we do not expect growth to be running ahead to any significant degree, and hence we also do not expect inflation to pick up to significantly higher levels. That's kind of underpinning our investment philosophy right now. We do think that you might see a bit of a pickup in U.S. growth from fiscal policy. It does seem to be a bit odd to us that we've chosen this point in the economic cycle to initiate fiscal policy. It seems rather late. We also don't necessarily think that it's going to add significantly to GDP growth, but you might see a little bit of a pickup in the second half of the year, which is going to continue to support the Federal Reserve in terms of their interest rate normalization program as they continue to raise rates. Our official call, for what it's worth, is still for 3 times over the course of the year, though obviously, as you could see from their last statement of economic projections, they're pretty much on the borderline between 3 and 4. Not that we think that that is going to matter significantly to markets. However, in the long run, we think that interest rates have to remain at very subdued levels for a very long period of time because you will simply not see the inflation pickup to justify significantly higher levels of yields, and hence we would remain very positive on various spread asset classes, namely credit and emerging markets.
Great. That's good to hear. I think when I think about emerging market debt, and this is primarily on the dollar side, I think that sort of a medium to long-term return is something in the mid to high single digits. So, 6 to 9%, I think, seems reasonable in a medium to long-term basis. The asset class has delivered a little bit more than that. So I think, that's sort of what one should think about in terms of return expectations. Given the current rate environment, I would say, it depends on whether you think that we're going to stay around here. So if you think 10-year rates at 3 seem reasonable, then I would say add 300 to 400 basis points, and that's sort of your expectation for return for emerging market debt. Right now, we're at the low end of that range at 310. I think if you want to start looking or placing a heavier concentration when it hits 350, 400, then that should be your expectation for return. When I look at and I think about emerging markets, generally speaking, I see it as an improving credit story. And if you look at the history and if you look at what we've seen in the last 20 plus years, it certainly has delivered. A lot of these countries, have migrated from high single B to double Bs to investment grade. Right now, if you look at our index has a mix of about 50% investment grade rated credits and 50% below. So that's sort of the credit quality you're getting. And it was interesting because I was listening to your keynote speaker talking about Kazakhstan and the fact they were able to issue. Kazakhstan is an investment grade rated credit. So if you comp it to what you're receiving in investment grade rated companies in the U.S., that seems about reasonable. So I guess the name may be, a little bit out there. The location may be a little bit out there. But I think for some of us that have been looking at these credits for a significant period of time, you certainly have seen significant changes. And so, if you believe or if you think that credits that are rated similarly should have sort of comparable credit fundamentals, then that's, I think, where you should place, those particular credits. And so you should, set your expectations accordingly.
Arthur?
Just echoing Luce's thoughts, I think we remain constructive on emerging markets for this year. I think a good way to look at it is to see where we've come from. Last year in 2017 was a very strong returning year for emerging market debt across the board. And you really look at why that occurred, and people refer to it as the push and pull factors. The push factors being the fact that you've had extremely low interest rates globally, pushing people into riskier asset classes or perceived to be riskier asset classes. That, in many ways, has normalized somewhat. So we're seeing higher rates, higher core rates. But yet the pull factors, the fundamental pillars of support for emerging markets are still very much in place. So some of these pillars of support are improving growth differentials relative to developed markets. The external position of many of these countries is much healthier than several years ago. And by that, I mean current account deficits have been shrunk. And so the starting point is a lot cleaner for many countries. You also have pretty low inflation across the board in EM. Yes, it's ticking up, but again, we've seen very credible monetary policy in recent years really kind of contain the inflation expectations, and that remains an anchor for EM as an asset class. And finally, real yields, especially in local markets, obviously, remain very elevated. So that's nominal yields, after inflation is stripped out of it. Real yields remain elevated, in particular if you compare it to developed markets. So all in all, I think we're still constructive. Maybe we're not going to get the double-digit returns that we saw last year, but we remain pretty constructive for the year.
Actually, Arthur, let me ask you a question about that. So the spread, you said the real yields are, the word you use, were fairly high.
Yeah.
What are we talking across the yield curve? And this is made for both you and Luz. Across the yield curve and duration, what is the spread between emerging markets and the U.S. Treasuries right now, roughly, on average?
So I think on the hard currency side of things, and by that I mean debt issued by these countries in US dollars or euros for that matter, but let's focus on US dollar debt. You're talking about Treasuries plus 300 on average, and for the higher rated sovereigns, you're talking about potentially low 100s. And there we don't see that much value because you're taking on this extra interest rate risk without being compensated. But the dollar pays probably around 250 to 300 out to, I'd say, 10 years. In local markets, it really depends where you're looking. In Central Eastern Europe, you can have 1% yielding countries all the way out to Argentina for good reason, high double digits. But for us, it's about having the scope and the kind of different sources of performance. So having some carry, having some price return, and in this environment, we do like to have some currency exposure also.
By the way, I'll just ask 2 or 3 more questions. I really like to make this as interactive as possible. I'm not a huge fan of panels, me just asking questions. So just a couple more questions, and I'll invite you all to chime in as well. I have to ask you because it's a topic on everyone's mind is the flat yield curve. Obviously, everyone has their views. Just what are your thoughts about it? Is it forecasting, premonition of something, or is it just a blip in your minds? I don't know who wants to start with that one.
I'll go ahead and start with that one. I mean, the flattening of the yield curve, we think, is telling you something. It's telling you something about what the market in general thinks about the future prospects for growth and inflation. The Fed has obviously been in our minds fairly aggressive in terms of increasing interest rates. It has had little to no impact on longer term U.S. interest rates, and hence the yield curve has flattened. What does that tend to say? I mean, it's been a pretty reliable predictor of a slowdown in the future. Most recessions, if you go back historically, are Fed-induced. The Fed over-tightens policy, and hence that causes the slowdown, which in credit, which leads to a recession. So in our minds, it's an indicator that has to be taken very, very seriously.
Any differences of opinion or same views?
Not that significant, yeah.
Similar views. It's just it's about the timing. So for the time being, the flattening is indicating something, but it's not imminent in terms of a recession on the horizon. It is something we're watchful of, and we remain constructive given other pieces of the puzzle. And so looking at the yield curve is not the only thing.
Actually, I agree with that, by the way. I guess my last question, then I'll open it up, is just on inflation. We've all alluded to a little bit. It's been modest globally. I guess one issue, commodity prices have generally, and that's my world of real estate, have increased substantially. And also the question on wages. We've had very tepid wage growth for a very long time here. People talk about the Phillips curve sort of being out of whack from historical perspective. With unemployment where it is, do you all foresee increases in wages? I mean, what do you see as the sort of the pressure on inflation, if anything, or is it what I think you said, Arthur, even more the same, or sort of modest inflation? I'm curious what y'all think about that. Inflation forecast.
Yeah, I'll kick it off. I think the house view of Payden Rygel is that yes, wages are growing. Yes, labor market is tight, but it's not causing overheating in the economy, and it's something we're going to have to watch for. Obviously, commodity prices is an added risk to that inflation forecast. On the emerging market side, which is what I focus on, there are countries that have problems with inflation. So Turkey is one, Argentina is another. In those countries, we do use inflation-linked instruments to kind of mitigate some of those risks. But on the whole, we've seen over the past decade, these central banks in many countries in emerging markets really gain a lot of credibility in implementing monetary policy, not only tightening, but also kind of loosening monetary policy at the right times. And I think we take a lot of comfort from that.
Yeah, I very similar views. I'd say just from our, say, more of our U.S. investments, we are concerned. I think there's been a lot of talk about inflation sort of appearing, but it just hasn't. But we have changed some of our investments to include more tips, and that's a departure from what we have been investing historically. So in our multi-sector products where we have a full mandate, we have seen that shift.
Just adding to what Arthur said, I mean, I think we're not particularly concerned about significantly higher inflation. Yes, the labor market seems to be telling you that we're at, near, or through full employment, but I think what we would just mention is there is potentially greater slack in the labor market than what the headline unemployment rate is indicating. One of the things that I like to say is that companies are hiring not necessarily because they have to, but because they can at a fairly low wage structure. And hence, once they would have to pay higher wages, they are likely to significantly shift into more technology and capital investment. You still have significant secular headwinds to significantly higher inflation, whether that be demographics, whether that be technological innovation. These are things that are going to continue to put pressure on inflation rates to stay below what you might generally think of as a late cycle sort of inflation level.
Cool. Well, let me do this, because I have other questions I'd like to ask, and I will certainly do that. But to the extent any of you out there in the audience have questions for our panelists, I guess we have a mic there. Feel free or raise your hand. I mean, there's not that many of you, so happy to take any questions that anybody might have on anything, or I'll keep going. Those of you who know me, I'll keep going. I won't stop. So, yeah. Oh, I'm like, I know you. I think we're Facebook friends.
There we go. Tariffs. Something we haven't had to think about in our industry for, I don't know, a generation. So I imagine investment committees are at least starting to talk about it. Are you even starting to talk about it in this phase? And the ones I'm specifically thinking about are the 301 section tariffs, i.e. the intellectual property, joint venture transfers, the ones that are going to be very difficult for China to agree to, as opposed to steel tariffs. It's a no-brainer. But those ones specifically, I'm kind of curious how you guys are thinking through your your prisoner dilemmas analysis, your strategy analysis, your feedback loops. Are you starting to even talk about that in the investment committee level, or is it still just let's wait and see?
You know you're talking about MBAs and these prisoner's dilemma in the question. This is an educated group. If you say Nash equilibrium, I'm throwing, you're out of here. All right, let's be clear. So tariffs, what do you guys think?
We've started to look at it, but to be honest, we're not too concerned as of yet that that's going to escalate. I think in terms of the number of risks out there, that's one of them, and trade wars will hurt emerging markets and the sector that we look at. Emerging markets has thrived based on global trade and free-flowing trade, and to stop that in any way, even if it's the talk of it, it does affect us. So at this stage, we're talking about it, but really we don't have too big a concern that it's going to escalate, because both sides would have a lot to lose were it to escalate. So that's the stage we're at, Payden.
I think it's hard to invest in emerging market, and especially in Mexico, and not have thought about what the potential impact could be. We've been talking about NAFTA for a while. It still is not resolved. We don't know if it's going to get resolved, if we're going to pull out. And then you add China on top of that, and the potential for dragging China in. And I think Mexico, for the emerging markets, can be well contained. Maybe it will create a contagion relative to Latin America. But as a whole, I would say it would have maybe less of an impact. China, however, would not be the case. And so the way that we're thinking about it and how we're trying to position is sort of the way that we're approaching the asset class. And that is, again, very similar to your keynote speaker, from a more cautious sort of positioning. We own assets and credits in China. All of them denominated in US dollars, so we're not taking any currency risk. And the bulk of the positions that we have there are state-owned credits that are rated at the investment grade level, mostly in energy, because we do think that they do have an interest in maintaining those credits. So to the extent that it creates a downdraft in terms of the growth potential for China, I do think that that is going to have repercussions for the emerging markets as a whole. But I do think also like higher interest rates may have repercussion for emerging markets as a whole. But again, in a medium to long-term expectation, it's hard for me to imagine how China's going to reverse all that growth potential and it's going to go back to where it was 20 years ago. I mean, it's one of the largest economies in the world. I don't see that going backwards. It may create a hiccup, but I don't see that going backwards. And then lastly, I would say, the fact that they have changed, let's say, their government and that they may now have a president for life, it does create some additional degrees of freedom. Because when you have somebody that is managing the economy, they can just basically, change a lot of the rules of the game with a stroke of a pen, which is kind of what we're doing here. So.
Anything to add, Keith?
Nothing particularly to add. It's something that we're talking about. We don't necessarily think that a trade war is imminent. We think that a lot of the tariff talk thus far has been very measured, relatively small when you compare it to the scale of trade and GDP that we're actually talking about. And I think one of the things, or at least one of the questions that I seem to get from clients pretty regularly is, do you think that a trade war and tariffs is going to be inflationary? And I think the resounding answer we would have is no. It might present a one-time price shock, but then that's it.
Should Trump get the Nobel Prize? Okay, no. Yes, sir, in the front row. Just speak up so everyone can hear you.
When you think about
Yeah, let me make sure everyone heard it. It had to do, I think, with the spreads sort of that you're talking about in terms of credit quality and duration. Where do you sort of find that sweet spot?
a little bit, yeah, when you reach for yield,
Sure.
you can buy
Okay.
riskier securities, or
Absolutely.
you can buy higher credit quality, longer dated securities.
Absolutely.
And you balance those.
Absolutely. So, yeah, just make sure everyone heard the question.
Yeah, I'll start on that one. When we've been looking at our portfolios, we've generally thought of duration as being a hedge to credit positions in general. When you have a risk-off event, risk-free U.S. Treasuries are likely to be the best performing asset, and hence it prevents that risk offset while also allowing you to collect a yield premium in a steady state environment. Right now, with as flat as the yield curve has gotten, I mean, for the longest time, our firm has held the view that the long end of the U.S. Treasury curve has provided the most amount of insurance that we could get per dollar relative to the spread overweights that we were running in our portfolios. Well, that calculus is starting to shift a little bit. And one of the things that we are looking at is now how much duration can you actually get from moving in the yield curve? Because with it being as flat as it is, what is going to offer you the most protection in the event that you get some sort of a risk-off scenario? Now, at the same time, we're also making moves to reduce some of our risk overweights as well, moving out of some of our high-yield securities up the capital structure into things like bank loans, where you are at a higher level of seniority within the company capital structure. We have somewhat reduced our investment-grade credit overweights and moved into things like U.S. agency mortgage-backed securities, where you've actually seen some cheapening given the exiting from the Fed balance sheet. So these are some things that we've on the margin done to try to improve the quality of our portfolio without taking an outright underweight to any risk asset, and still try to figure out where the best offset to these risks lies.
Arthur, Luz?
I would I think that those are very similar positionings, let's say. We tend to run, in a multi-sector fund, we tend to run sort of shorter on the duration front, just generally speaking, trying to provide the same sort of yield for our investors. We look at the yield to duration, so try at least to have, one sort of a ratio of 1 plus. So that's how we look at it. In terms of credit quality, it's individual positioning for the different sectors. So for emerging markets, probably since the fourth quarter of last year, we started sort of moving up the credit curve. And probably in the third quarter of last year, we started shortening duration. And that would be very similar to, say, what the other credit markets have been doing.
I'll just add a quick point. On the emerging market side, really the one comment I can make on duration from a high level is, for us, we've had the view for a while to be underweight investment grade duration and preferring high yield, especially in some of the up-and-coming countries, some of the next generation countries in Africa or in Asia, where you get the extra compensation and spread. So in a rising US rate environment, you get that spread compression to offset it, and you earn that yield. On the local markets too, we've kind of veered towards adding a bit more frontier type exposure on the local market side. So in countries like Egypt, Nigeria, where you can get double-digit yields for treasury bills, you're not really taking on any duration, and you just have to worry about the currency regime, and in both, that's been quite stable. So it really depends on EM. It's not as easy as looking at a duration number or even credit quality, because each country has its own story and goes through its own cycle. So I think the way to look at emerging market from a high level, for us anyway, has been to underweight IG and instead of it having more high yield type sovereign exposure.
Yes, sir.
Down the street at the Milken conference,
Make sure you speak up so everyone can hear. Yeah, it's okay.
at the Milken conference, the head of the World Bank's this index.
So just make sure everyone heard it. It was, I guess, the relationship between health and education of various countries and
ranking.
And impact on fixed income.
No, ranking the countries. One country against another.
But presumably for some fixed income decision making, I mean, right, okay.
So when we look at emerging markets, and I think the reason that emerging markets have been able to improve over, let's say, the last 25 years that I've been involved in this asset class, it's because, precisely because they've been able to sort of move and increase the overall standard of living for their population. And when I think about sort of what's going to drive a credit from just sort of a stable state and move it into a sort of further improvement, you certainly have to look at human capital and what is that level of education and what are the safety nets that our country is providing. One of the things that we key off the most is what are the reform prospects for that country, because that really is what is going to migrate it up the curve, if you will, for us, and it's going to migrate it up the investment grade curve. So it is something that we look at. It's not necessarily something that we rank relative to other countries, so we don't give it a grade, if you will. But it is something that's important, and I think it in totality is something that is sort of expressed when you see the ratings of those countries as they move up the credit curve. It's interesting you mentioned that, because one of the things that a lot of people are talking about, especially I'd say I would start probably with the Europeans, they're talking about the environment, socially responsible investing, as well as the governability, so ESG investing, and whether that's happening. And it was interesting because there are a suite of funds that have actually been introduced that are run by the company that is, for us, basically runs emerging market indices, which is JP Morgan, and they actually are giving grades specifically to companies as well as to countries. And so the hope is that more investment will be geared towards the companies and countries that rank better, on those three sort of areas.
Just to echo Luz's thoughts, we've been implementing ESG into our process for a while, and it's absolutely necessary when you're looking at emerging markets to look at things like education, because as Luz mentioned, ultimately what we're looking for is the improvement in the trajectory of these sovereigns, and part of that is improved growth, and in order for that to happen, you really need an educated workforce and educated population. So ESG is at the forefront for many managers, including us.
Sure. Is a question in the back somewhere? Yeah, sir, go ahead. Wow, Singapore, Indonesia, someone's done some homework. Wow. So.
And the last part was.
It was a little hard to hear. So the question was what
the impact of the
relative
monsoon.
You're absolutely right. That is wow.
You're absolutely right. They are in the monsoon region, and it is something that we're not going to. I'm not going to stand here and say we try to predict. All we can do is to kind of look at each country. We're not involved, just for full disclosure, we're not involved in Singapore, but do like both Malaysia and Indonesia. And you know, we like them for different reasons. First and foremost, I think we have to, when you're talking about the monsoon, the main impact of that will be on inflation, ultimately, for those countries in that region. So in order to really tackle that issue and that risk, we have to be comfortable with central bank policy. I mentioned it earlier, but both Malaysia and Indonesia have done a good job in recent years of addressing the things that they can control, right? So implementing tighter monetary policy in Indonesia's case after the taper tantrum in 2013. And you know, they've both done a good job at controlling what they can control. The monsoon season affects some countries more than others, and some are exposed more than others. And it's a risk we're cognizant of, but I think it's important for us to look at the other elements that are more controllable.
So we are long Singapore, and we have investments in Malaysia and Indonesia. So, and part of that for us is when we started to think about shortening the duration and increasing up the credit curve, we had, I would say probably, we had been underweight Asia for a while, and then we decided to start increasing that allocation. And those were the countries that we gravitated towards simply because those are countries that, well, number one, are investment grade, so we like that prospect about it. We're investing in dollar-denominated credits, and they offer a significant amount of, let's say, stability, because there's a lot of money in Asia that buys Asian product. And so whenever there's a hiccup in the US, you see the stability of those credits be maintained, because in terms of the pricing, because you have a lot of pension plans and a lot of insurance companies that will buy Asian products because they know each other. We actually own a AAA rated bond out of Singapore that we like. So there's not that many around. That's the only reason I mention it.
I actually wanted to interject a question that's not quite so specific in terms of countries, is of course the new tax bill. Limits on interest deductibility potentially, changes in corporate tax rates, and of course repatriation issues. Mm-hmm. And you know, I'm not sure exactly how much money is going to come back from U.S. companies, but a couple $1 trillion, who knows how much might ultimately come back. What impact do you see on all those things, on rates, fixed income issuances, I don't know, the markets generally? What do you guys think? Yeah, the professor's asking a tough question. I gotta be on the final exam, I don't know. You're all getting B pluses right now. Yeah, we'll see what we can do.
In general, we don't necessarily think that companies are bringing back money from overseas so that they can retire debt that they've been issuing over the last several years. In most cases, you're talking about very large tech companies primarily. There are others out there, but when they've issued debt, investment grade debt to be very specific in the last several years, they've done so at incredibly low interest rates. They haven't necessarily needed it. It's not because they had some massive investment project that they needed funds for that they just couldn't access from overseas, and so they were going to issue debt, and now they're going to bring the money back at a significantly lower tax rate and retire that debt. No, they're likely to leave this debt outstanding. So it's not likely to change the issuance patterns until interest rates go up more significantly. They're likely to continue issuing debt, and they're likely to continue doing projects that are beneficial to their shareholders, which is primarily what they've used a lot of the money that they've issued in the debt markets to do. So we don't really think from that perspective that the tax bill and the repatriation is going to have a significant impact on the issuance of investment grade credit.
Maybe I should have been clear too, because a lot of these firms, and you're right, it's heavy in tech, own a lot of foreign bonds. I mean, if you look at their portfolios, a lot of that overseas cash is held in fixed income investments overseas. So part of the question was, were they going to be monetizing those, selling those off, and then whatever they do with the money when it comes back here is a question.
In general, so you're talking more about like the Libor OIS spreads that we've been seeing talked about. Yeah, so a lot of these companies with that corporate cash that has been parked overseas, they've invested in a significant amount of very short-term U.S. credit. One of the things that you saw over the last couple of months was that the largest underperformer in the credit markets was the front end of the corporate curve. 2- and 3-year paper significantly underperformed longer-term investment-grade debt. We viewed that as an opportunity because there is a significant amount of money that is looking for higher yields. You have started to see that reverse somewhat. It's not fully reversed, but it continues to present a very attractive investment opportunity. At the same time, one of the big mysteries that we were getting questions from clients about was the widening of Libor rates relative to risk-free overnight index swap rates, which in essence represents the risk-free investment rate of the U.S. government. That has been partially impacted by this selling of front-end credit, along with the increasing Treasury bill issuance to fund our deficits up through the April tax receipts. So you've seen some impacts, but it's in parts of the market that we think are likely to normalize over the coming few months.
I think an additional element involved here and affects emerging markets in a specific way is the potential impact on the US dollar. So rising front-end rates is supportive of the US dollar, and we've seen in recent weeks that play out. So that's one side of the argument in terms of favoring the dollar. For us, the outlook for the dollar still remains mixed. I think the negative side for the dollar remains the fact that the US is looking to expand its fiscal deficit at a time when the output gap is turning positive. And historically, if you look at that scenario, it doesn't bode too well for the US dollar. I'm not saying that means US dollar needs to depreciate massively. It's just a counter balancing force to offset some of the structural positives for the US dollar that still makes us comfortable owning local currency debt.
Ruth, any thoughts? Okay. I'll open it up again. Anyone out there with questions? Yeah, right in the heart. Yes, sir. Yeah, just speak up. So try to. Yeah, I'll repeat the question. So tell everybody. Okay. So the question was, who's going to replace the ECB as a buyer of much of the European debt, especially in some of those weaker countries? It sounds like, and emerging markets. Guys, Lucy, you want to start? Why not?
That's one of the risks, but I think that's one of the risks of just the easy liquidity conditions that we've had, generally speaking. So I do worry, and it is somewhat concerning. Greece theoretically was in our markets once upon a time, in the not so distant past. It's when you think about the potential for who's buying and who owns it, a lot of local, let's say, money could be tapped. We were talking earlier about the sovereign wealth funds. They've been buyers, the Asians, a lot of buyers. So to me, it's not just the ECB sort of decreasing their overall purchases, but it's the US, the Fed, the ECB, and the Japanese. And that, to me, would lead to sort of a spread widening, generally speaking, across all credit markets.
Yeah. I think it's absolutely, I agree with you in terms of some of the Central Eastern European countries have benefited from this liquidity coming over from core Europe, and they'll be at risk of rising rates. For us, they're not attractive to begin with because real yields in a country like Czech Republic or Hungary, for that matter, are not attractive enough. They're barely positive, if not negative, in the Czech Republic's case. So we don't like those countries from a bond perspective. The currency is different, but
At this price.
At this price,
right?
Yeah. If it was to happen, if the ECB liquidity is withdrawn, we'll see those underperform. Those markets underperform.
Keith, agree?
I agree, and the only thing I would add to that is that we don't really expect the ECB to do a hard stop on their quantitative easing. That is just not the pattern that the governors on the ECB have shown historically. In general, they've been very dovish in their approach, very similar to our central bank, and they are likely to have some sort of a longer-term withdrawal pattern that the market seems like it's prepared to absorb.
Cool. Good question. Yes, sir. Okay, so the question was on political risk. You mentioned Mexico and Brazil specifically, and just how you think about politics in terms of portfolio construction or investing. Is that okay?
Yeah. Well, it's obviously hugely important because it's going to determine policy making, on a going forward basis, and maybe backwards. So when we think about, the potential for the candidates and who may, be the ultimate winner. I mean, in Mexico, it seems like it's almost consensus view that López Obrador will finally win this third time around. And so as investors, certainly we have to be at least a little bit nervous or a little bit concerned given some of his rhetoric of the past. We have tended to see that, a lot of politicians, let's say, run from the left, but govern from the center. So if you look at in Brazil back in the early 2000s with Lula, that created a huge impact on our market. And then, everybody was well satisfied that he did okay. When you look at Humala in Peru, very similar trajectory. So I think when I look at López Obrador, I think, it's certainly a concern. So how do I deal with it? Positioning. What can I buy that can maybe not be as affected or as impacted by having that type of politician or that type of president? We have a lot of companies. Well, there's a sovereign, and that's going to be affected because the president is important. But there are a lot of companies that are exporters that generate their money in dollars that may not be affected by any policies that he may implement. There are other credits that will certainly be because he's already talking about them. So, for example, he's been talking about stopping an airport project, and they just issued several $1 billion worth of bonds. Those bonds have been getting hit significantly. So you just avoid them, or you're at least think about that exposure when you go in at the get-go. So to me, it's the positioning. You choose the credits that you think maybe can sidestep that, or you look at your overall positioning sort of as a potential underweight. In Brazil, it's a little bit different because in Brazil, the field is not yet sort of been weeded out, but there is the potential that there may be sort of a leftist candidate, and that may be the grouping that wins. It was very interesting when week and a half ago, we were at the World Bank IMF meetings and heard a presentation from one of the research teams that focuses on EM, and they were talking about basically politicians and politics, especially within Latin America, and the fact that it seems as if the U.S. is basically exporting this sort of populism, sentiment. To Latin America. And so I think people, the previous year, everybody thought, well, there's only populism in the developed world, and we've managed to sidestep it, and now it's coming back. And it's not necessarily that everybody's sort of from the left. Now we have very hard right candidates, and it's almost the extremes. And I think part of it is that just people are upset. And this is sort of the embarrassment of riches. These are countries that have now created a large middle class, and a middle class that is fed up of not enjoying more of the wealth of the country, kind of like we found ourselves in, let's say maybe perhaps in 2016, where there was this anger, this sentiment that led to the ultimate outcome of our presidential sort of election. And now we're seeing that expressed in some of these countries. So to me, that's sort of how we think of it. It's certainly extremely important because it is going to drive the policies, and that's the single thing that we key off of in terms of where we see the future of that country. But I would say that, having said all that, there are very strong institutions, believe it or not, even within these emerging economies, and they're very strong policymakers. I mean, when I look at Latin America specifically, probably with the exception of Venezuela and Ecuador, you look and you go and listen to the head of the central bank or the finance ministers or sometimes even the candidates themselves. And a lot of them, extremely well educated. Some, a good portion of them have been educated in the U.S. or in the developed world. A lot of them have been through either the IMF or the World Bank. They've done their tours of those institutions, and they've gone back to their countries. And a lot of them actually have also gone through a lot of the large investment banks. Argentina actually pulled some bankers out of J.P. Morgan to head, some of their different, either the central bank or the finance ministers' positions. So to me, when you think about the quality and the level of policymakers that you have, extremely different what you have today versus what you had 20 years ago. And it gives me a lot more hope and a lot more faith that we will be able to continue, again, to migrate up the credit curve. Maybe not on a straight line, but in the medium to long term. And that's why I'm optimistic in terms of the asset class as a whole.
That'll teach you to ask a political question again.
Oh, is that too long?
No. It's just there's so much to say. By the way, I was thinking as you were saying exported from the U.S. I think you meant Russia, but anyways, I mean Hungary and Italy. I mean nationalism is exported there too. So wherever the source is, we can just discuss it. You had one. Let me see. I'll come back to you. I promise. If there's no other questions for anyone else in the audience, anyone else have a question out there? All right. You asked about Singapore and Malaysia, so where are we going now? If there's certain political parties that if they win or are gaining traction, those countries are blacklisted from debt investments, is that including the Jared Kushner family, is that what you said?
The Kushner.
Argentine.
I wasn't sure what, my hearing isn't so good. I was like, Jared, the Kushner family, what?
I'll start with that. I think the simple answer is no, we don't have a rule in that way. The way we approach investing in EM debt is really to look at the sovereign trajectory. Before we look at asset pricing or what we think the total return is going to be, let's just have a look at the next 6 months or 12 months. How is this sovereign going to be moving in terms of a number of fundamental factors? And if we have a negative view, we may still go on to invest because we need to have the fundamental view, but then we also need to incorporate the valuation in those markets. And really, our job is really to monetize these views and to achieve the best returns we can for our clients. So it's all well and good that we may have a negative view on the country, but if the valuation is already reflecting all of those risks, then it's our job to really filter through that and to make that call whether or not we're going to be invested in it. So simple answer is no, we don't have a rule. It's more about, are we getting paid for the risks for the most part?
So I would say that we have maybe a slightly different approach. We use a bottom-up approach, and when we talk to clients, we talk to them about investing in, let's say, stable to improving credits. There are certain credits that are just not going to meet that particular sort of outlook, and so we won't be invested there. There are others. Russia's a perfect example. We've been out of Russia for a while. And simply because we don't know what's going to happen in terms of additional sanctions or not, and we don't want to be caught up in a situation where we own the debt and then we won't be able to get out of it when the U.S. government decides that we can no longer hold it for our investors, because we just went through a mini version of that, and it was very severe in terms of the sharp price movement that we cannot guess. There are other countries like Venezuela, for example, that we've been out for a while because of the current president and the sort of the direction of their policy making. It's extremely hard for me to see how we change that without a new administration. So there are no hard and fast, where we blackball everyone, but there are certain things that we look at, and as I've mentioned before, one of the things we key off the most is whether the country is committed to making the structural changes that they need to sort of continue to migrate up the credit curve. And for us, that really is extremely important, because that's when you start to get what we like to think of sort of the types of returns that are going to be sustainable, where if a credit goes from double B to triple B, and then even if it just stays there, but then from triple B to single A or double A, the spread compression that occurs when you make that jump, you're not going to give it back. And so that's sort of what we're trying to attach ourselves to in terms of making investments in this asset class.
We just have a few minutes, so I wanted to throw out a couple questions. One, I want to bring it back to the U.S. really quickly on the high yield markets. So I think I read in today's journal, or maybe it was on Friday, that even with the recent volatility, the spreads in the high yield market really have not expanded at all. Netflix issued bonds, I think last week, it was oversubscribed, 5.75%. I was teaching a case on Netflix, and I don't get it. So tell me, Tesla's issued bonds at rates, of course, okay, enough. To walk us through your thoughts on the high yield market. It just seems those spreads are too narrow, and I've sensed personally a tremendous amount of risk, too much liquidity, and I'm curious what your thoughts are looking over the next year on high yield spreads.
I would say it's something you have to be very much concerned about. I mean, this is about as low from an absolute yield level as well as the spread level as you've seen in high yield. Typically, this is the bottom, and everything goes wider from here. Now, I would just put the caveat on that credit fundamentals are still very good. Leverage ratios have crept up a little bit, but they're still not at levels that would significantly worry us. But given the fact that you're getting compensated so little for the additional credit risk, it just doesn't seem to us to be the best place to be using our risk budget at the current time. We think that there are better opportunities out there. I mentioned bank loans earlier. You can still kind of stay within the high yield space, but move up the capital structure. And in addition, I think it really emphasizes the fact that you need to have good, solid, fundamental credit research going on. One of the biggest things that you can do within credit investing, and high yield in particular, is to avoid the companies that are going to default. You saw a chart from our keynote speaker earlier about how low default rates have been. That is something that you have to be concerned about when they go up, which they inevitably will. What are going to be the companies that are going to be caught up in that, and have you done your homework to try to identify those early and avoid those credits?
So it was interesting that you mentioned Tesla, because I saw a headline today that said, Tesla burns cash, not fuel. And I think that's probably about right. So
that was my lecture last week, actually.
I don't invest in the U.S. high yield market, but we do have to care, because that's how we price our high yield bonds and EM. So you have to have a measure by which it's a starting base for what value is. And so we do tend to think about the levels of the U.S. high yield market and how does that compare to high yield bonds within EM. I got to tell you, we started getting, as I mentioned earlier, we started getting defensive, end of last year, and no satisfaction out of that trade for the first quarter of this year, because the high yield market in our asset class did so well. So all of the next gen credits had been performing extremely well, and so I may not get any satisfaction out of that trade going forward. But again, looking at sort of what I'm leaving on the table and the expectation for return by investing in those credits, I'm okay walking away from that, just like I'm okay not having any exposure in Venezuela. Last month, it killed me. Venezuela was up almost 11% on the month. Wow. So it's part of, to me, it's part of our approach to the asset class, how we invest, and how we communicate that to clients. So as long as clients understand us and what we're doing, then I'm okay. And this is a methodology and an investment approach that we've had now for 20 plus years, and it's worked. So I'm not looking to change it at this point in time.
We're basically out of time, so real quick, just a one-word answer. End of the year, 10-year, closer to 2.5%, 3 or 3.5%. Arthur?
3.
Luz?
3.5.
Ooh.
3.
3. All right, there you go. All right, well, I'd like to thank, and hopefully you'll thank our panelists, Arthur, Luz, and Keith.